Good morning, class. This is a tutorial on a corporate balance sheet. Here are just the T accounts that you'll be using and with their normal balances, which is a little different from what we've been used to with the sole proprietorship. I'll be doing a second video which will break down the equity section a bit further. But this is just a handout that you can print out that's there, and I would suggest you use it. These are all the accounts you will be using for this chapter. So if you printed this out, you could use this blank area here to do your journal entries for practice for your homework. But we'll be dealing with a corporate balance sheet, will be assets, we'll be dealing with cash. The liabilities will be dividends payable, and then there's the equity capital. Preferred stock, all of these are normal balance until it's changed. So it's preferred stock, paid in capital excess of par preferred stock, common stock at par, paid in capital excess of par common stock. Then there's treasury stock, which is a contra account to the common stock. We use this for when we purchase common stock back. Paid in capital excessive cost treasury stock, because when we buy the treasury stock, we buy it back at cost. Then we have retained earnings. Everything else here would be paid in capital from selling stock or purchasing stock back. Retained earnings, this is what we used to use the income summary to move net income up to the owner's equity section. Well, this corporations, we keep them separate. This is used for net income, profit, net loss, and this is a running balance. This is a balance sheet item. And then we have dividends, and dividends is a temporary account. We'll talk more about dividends after, but it's a contra account to retained earnings, which means we'll be closing it out to retained earnings at the end of the year. So dividends are part of retained earnings. Dividends come out of retained earnings. So this will just a brief handout, some brief information on what you could use this for. Thank you, and I'll see you in the next presentation.